I stopped using banks. Well, let me rephrase that. I stopped letting banks use me. For years, the rich have understood a secret that the poor have not, and the middle class have not. The rules of money are different for those who make them versus those who follow them. The average person works hard, gives their money to a banker, hopes for a tiny return while paying massive interest on their own debt. This system is not designed for your success. It's designed to keep you in the rat race, running but never getting ahead. You are taught to save money, but your savings lose value every day to inflation. The financial education in school was incomplete. My rich dad always said, "The rich don't work for money. They have money work for them." The average person is caught in a financial vice, a relentless pressure cooker that silently dictates the course of their lives. It's a feeling many of us know intimately. The sense that no matter how hard you work, you're just treading water. You're being squeezed from two sides, by two powerful and often misunderstood forces. Understanding these forces is the first critical step toward breaking free. On one side, you have taxes. For most people, this is the single largest expense they will ever have, dwarfing even their mortgage or their children's education. It's a silent partner in your career, taking a significant cut of every dollar you earn. Let's break this down, because the complexity is where the trap is hidden. First, there's income tax. This is what most people think of, the percentage taken by the federal and state governments from your salary or wages. But it doesn't stop there. On top of income tax, you have payroll taxes, Social Security and Medicare, deducted from your paycheck. That's another slice gone before the money ever hits your bank account. So, you've been taxed on your earnings. Now, you take your after-tax money to the store. When you buy goods and services, you're hit with sales tax. It's a tax on your consumption. Think about it. You're being taxed for earning the money and then taxed again for spending it. And the system is designed to tax your financial progress as well. If you manage to save and invest some of what's left, and your investments grow, you'll face capital gains taxes when you sell. The government takes a piece of your investment profits. And finally, after a lifetime of paying all these taxes, when you want to pass on what you've built to the next generation, your estate could be subject to estate taxes. It's a cradle-to-grave system of taxation. Let's put this into perspective. Imagine you earn $100,000. Between federal, state, and payroll taxes, you might lose 30 to 40% right off the top. That leaves you with, say, $65,000. Then, every time you spend that money, sales tax, property tax, gas tax, and other fees chip away at it further. The cumulative effect is staggering. Now let's look at the other side of the vice, debt. We are taught to pursue the American dream, which usually involves taking on significant debt, mortgages, car loans, student loans, and the ever-present lure of credit cards. But what isn't clearly taught is the brutal reality of compounding interest when it works against you. You don't just pay back what you borrowed, you pay enormous sums of interest to banks for the privilege of using their money. Consider a typical 30-year mortgage. On a $400,000 loan at a 6% interest rate, you will end up paying over $460,000 in interest alone. That's more than the original loan amount. For the first decade or more, the vast majority of your monthly payment isn't building your equity. It's going directly to the bank as pure profit. Or think about credit card debt. With interest rates often exceeding 20%, a seemingly manageable $5,000 balance can take over a decade to pay off if you only make minimum payments, costing you thousands in interest. It's a treadmill designed to keep you paying. This cycle of earning, being taxed heavily, and then paying massive amounts of interest on debt is the very definition of the rat race my rich dad warned me about. You work harder to get a raise, but that pushes you into a higher tax bracket, so a large portion of your raise vanishes. You use what's left to finance a slightly better lifestyle, a bigger house, a newer car, which means taking on more debt and committing more of your future income to interest payments. Most people simply accept this as normal. They accept that a third or more of their income will vanish to taxes before they can even decide what to do with it. They sign up for decades of loan payments that enrich banks and financial institutions, effectively renting their own lifestyle. They see their paycheck, see the deductions, sigh, and move on, never questioning the structure of the system itself. We are taught that personal debt is bad, yet the entire modern economy is built on it. Governments, corporations, and banks all use debt strategically to grow and create wealth. The wealthy use debt to acquire assets that generate income, making their money work for them. But the average person is taught only to use debt for liabilities, things that take money out of their pocket. This is the fundamental difference. The system isn't just rigged, it's rigged through a deliberate lack of financial education. We are taught how to be good employees, how to earn a paycheck, but not how to manage, protect, and grow our money. We aren't taught how the tax code truly works, or how to use debt as a tool instead of a trap. The problem isn't just money. The problem is a lack of control. When you don't understand the rules of the game, you are forced to play by someone else's rules. And those rules are designed to keep you running in that wheel, forever chasing a piece of cheese that stays just out of reach. Have you ever felt like you're playing a game where the rules are designed for someone else to win? You work hard, you save what you can, you invest, but somehow you feel like you're just running in place on a financial treadmill. This feeling, this cycle of earning, spending, and borrowing from institutions that profit from your every move is what many call the modern-day rat race. It's a system where your money flows away from you and into the coffers of large financial institutions. But what if you could fundamentally change the rules of your own financial game? What if you could build your own private financial system, a bank that you own and control, turning the tables in your favor? To understand how to build your own system, you first need to understand the one you're already in. The traditional banking system is built on a simple, powerful incentive: to use your money to make more money for the bank. When you deposit your savings, you're not just storing it in a vault, you are lending it to the bank for a very low interest rate. The bank then takes that capital and lends it out for mortgages, car loans, and business loans at a much higher rate, capturing the difference, which is known as the interest rate spread. Historically, this was governed by a fractional reserve system, where banks had to keep a certain fraction of deposits on hand. However, the financial world has evolved. In many modern economies, including the United States since 2020, reserve requirements have been reduced to zero. This means banks can, in essence, create money out of thin air when they issue a loan. A loan creates a new deposit in the borrower's account, expanding the money supply. The entire system is designed to keep capital moving and generating profits for the banks. Every time you take out a loan, you are paying interest that enriches that system. Every dollar you save in a traditional account is being leveraged by others for their profit. This is the core of the rat race. You are financing your own debt through a system that you don't own or control. Now, imagine a different reality. What if you could borrow money whenever you needed it, for any reason at all? A business investment, a down payment on a property, a child's education, or even a dream vacation, without filling out a single application or asking for permission from a loan officer. And what if, instead of paying interest to a commercial bank, you could pay that interest back to yourself, recapturing the financing costs that would have otherwise been lost forever? This is not a financial fantasy or a far-fetched dream. This is the power and the promise of the infinite banking concept, often referred to as IBC. It's a time-tested strategy that allows you to step outside the conventional banking system and create a financial world of your own. In simple terms, IBC uses a specially designed dividend-paying whole life insurance policy as the chassis for your personal bank. This isn't the typical life insurance sold as just a death benefit. This is a high-octane financial tool. By structuring the policy correctly, you privatize the banking function for yourself and your family. You effectively cut out the commercial bank as the middleman, and, in doing so, you get to keep the profits that they would have made. This isn't a new or untested idea. The wealthy have quietly used this strategy for generations to build, protect, and pass on their fortunes. They understood that the key to true financial independence isn't just about earning more money, but about controlling the flow of that money. A properly structured whole life policy is a powerful, multifaceted asset it is fundamentally different from the typical policy your average agent might pitch. The standard whole life policy is often designed to maximize the agent's commission and the insurance company's profit, with slow cash value growth in the early years. An IBC-style policy, by contrast, is engineered for the policyholder. It's designed for high cash value, it's eligible for dividends from a mutual insurance company, and it's structured for maximum growth and immediate liquidity. The goal is to get as much of your premium as possible working for you in your cash value, as quickly as possible. Your contributions, which are your policy premiums, build a growing pool of capital known as the cash surrender value. This is your money, your equity in the policy. And this pool of money is accessible to you at any time, for any reason, typically without the taxes or penalties you'd face with other retirement accounts like a 401k. You don't need to justify your loan to anyone. You simply request the funds, and the insurance company sends you a check or wire transfer, using your policy's cash value as collateral. Better still, this cash value grows tax-deferred, completely shielded from market volatility. While the stock market is on a roller coaster of ups and downs, your policy's cash value grows predictably every single day, based on contractual guarantees and non-guaranteed dividends. It provides a stable, predictable, and secure foundation upon which you can build your financial empire, giving you the peace of mind and the power to seize opportunities when they arise. This is how you stop financing the banking system and start financing your own life. Understanding the flow of money within your personal banking system is the absolute key to unlocking its power. It's about shifting your mindset from being a mere consumer of financial products to becoming the owner and controller of your own capital warehouse. My rich dad always said, "The rich focus on cash flow, while the poor and middle class focus on savings." This isn't just a clever phrase, it's a fundamental truth about wealth creation. Saving is passive. It's about parking money. Cash flow is active. It's about putting your money to work, constantly moving and growing. The infinite banking concept is the ultimate cash flow machine, a private system designed to make your money move with purpose. So how does this engine actually work? Let's walk through a tangible step-by-step example. Imagine you're a business owner and you need $50,000 for a new piece of equipment that will increase your productivity and profits. The old way? You'd go to a commercial bank, hat in hand. You'd fill out mountains of paperwork, submit your business plans, undergo a rigorous credit check, and wait weeks or even months for an answer that might be no. With your own banking system, the process is radically different. Instead of begging a bank, you simply request a policy loan from your life insurance company. Let's assume your policy has a cash value of $100,000. You call your insurer or log into their portal and request a $50,000 loan. There are no questions about what you need the money for. There's no credit check because you are borrowing against an asset you already own. Within a few business days, the $50,000 arrives in your bank account via check or wire transfer. It's your capital, ready to be deployed. Now, here is the most critical part to understand, the detail that makes this entire strategy so powerful. The $50,000 you received did not come your policy's cash value. It came from the insurance company's massive general account. Your cash value was simply used as collateral to secure the loan. This means your full $100,000 of cash value remains inside your policy, undisturbed. It is still earning its guaranteed rate of interest, and, in a participating policy, it's still eligible to receive non-guaranteed dividends. Let's say your policy is being credited at a gross rate of 5% for the year. Your $100,000 is still working for you, generating $5,000 in growth, even while you have a $50,000 loan outstanding. Your money is now working in two places at once. It's compounding inside the tax-advantaged environment of your policy, and it's at work in your business, generating new revenue from the equipment you purchased. This is the essence of velocity of money. Of course, the loan isn't free. The insurance company will charge you interest, let's say at a rate of 6% in this example. So, on your $50,000 loan, you'll owe $3,000 in interest for the year. But remember, your policy earned $5,000. The net effect is that your access to capital only cost you the spread between your loan rate and your policy's crediting rate. More importantly, you controlled the entire process. Now we come to repayment, and this is where your power as the banker truly shines. Unlike a rigid bank loan with fixed monthly payments and penalties for deviation, you control the repayment schedule. You decide when and how much to pay back. You could pay it back quickly to free up your collateral for the next opportunity. You could pay it back slowly over many years. You could even choose to defer payments, letting the interest accrue against your cash value, though this is a decision to be made carefully. But the smart banker, the one who truly wants to build a financial fortress, repays the loan systematically with interest. Why? Because you are recapturing the principal and interest for your own system. Think about it. When you pay interest to a commercial bank, that money is gone forever. It becomes their profit. When you pay interest on a policy loan, you are strengthening the very same mutual insurance company that you are a part owner of. Your interest payments contribute to the company's profitability, which in turn fuels the future dividends they pay out to policyholders like you. It's a virtuous cycle. You are, in effect, paying yourself. This is the simple, elegant, and powerful engine of your financial life. You capitalize your system with premiums. You borrow against it to seize opportunities, and you repay it to recapture your capital and fortify your financial position for the future. This is how you break free from the traditional banking system and build true, lasting wealth on your own terms. Let's look at a real-world example. Meet Maria, 35-year-old entrepreneur, tired of being at the mercy of banks. She learns about the infinite banking concept and decides to take control. She sets up a dividend-paying whole life policy with a specialist, commits $15,000 per year, much into the PUA rider, rapidly building cash value, growing steadily and tax-deferred, unaffected by market chaos. After 5 years, she has about $80,000 in cash value. She takes a $40,000 policy loan for the down payment. Funds arrive within a week. Her policy keeps compounding while the property cash flows. She repays over 7 years, paying 5% interest back into the system. Later, she buys a car with another policy loan. She is her own bank. Over time, she funds investments and education, operating from power, not permission. Building your own bank is like constructing a skyscraper. It requires a solid blueprint, the right materials, and a team of experts. Most agents don't understand IBC. Find a specialist strategist. Use a dividend-paying whole life policy from a mutual company. As a policyholder, you're an owner and share in company profits. Guarantees on cash value and death benefit, insulated from market risk. Add a PUA rider to overfund and turbocharge early cash value. You're building a bank. Banks need capital. Contribute the maximum into PUA while avoiding MEC to preserve tax benefits. Transfer from low-performing accounts into your high-performing tax-advantaged system. Establish, fund aggressively early, then let it compound tax-deferred. Major mutuals have paid dividends through depressions, wars, recessions, creating a stable, secure, liquid financial fortress. IBC is powerful and dangerous in the hands of the uninformed or undisciplined. The biggest danger is choosing a standard policy with high commissions and low early cash value. It can cripple your strategy for a decade or more. Another risk is undercapitalization. People love borrowing but neglect funding the bank. Consistent funding, especially early, is mandatory. Flexibility is a feature, not an excuse to avoid repayment. Unchecked loans accrue interest and can erode equity over decades. Mind the MEC limit, exceed it, and tax benefits collapse. Loans and withdrawals could become taxable. Work with a qualified specialist to design for IBC. Knowledge and expert guidance are mandatory. The infinite banking concept is not for everyone. Are you ready? It's for those who take 100% responsibility and want control above all else. Control over capital, financing, and legacy. For owners needing reliable capital to weather storms and seize opportunities. For investors who understand leverage. For patient, disciplined, long-term thinkers. If you're paycheck to paycheck, first increase cash flow before starting IBC. If you want immediate, high-risk returns, the stability here will feel too slow. This is the foundation, not the speculative spire. For families building generational wealth and enjoying significant tax advantages. If you're fed up with the rat race and bank interest, you're a prime candidate for financial sovereignty. You've seen the trap and a way out. What do you do with this information? Knowledge without action is worthless. The gap is action. The rich educate quickly and take decisive action. Stop spectating. Get on the field. Your first step isn't to buy a policy. Invest in your education. Read Becoming Your Own Banker by R. Nelson Nash. Non-negotiable. Learn to vet specialists. PUA Writer. MEC Limit. Capitalization Strategy. A true expert welcomes hard questions. Decide to become the banker, not just the borrower. Your future depends not on salary, but on strategy. Start building your own bank today.